In this video, you will see how we are able to predict GBP, JPY price movement using fundamental analysis.
Looking at the GJ, so we're gonna start with the same. So when we analyze a pair, this is GJ. So currently we are analyzing GJ. So currently we are, just a second. We are analyzing GJ. And what do we look? Number one, macroeconomic, let's call it data, fundamentals, macroeconomic picture, okay? So what is the macroeconomic picture of the GJ? When you look at the macroeconomic picture, let's put it like this. You can later take a print screen or take a picture of it, so you have a lot more like remembered for the next meeting. When we look at the macroeconomic data and the fundamentals, we first look at what is the fiscal policy and then what is the monetary policy. So you need to know what is fiscal and what is monetary policy. So when we look at macroeconomic data, what is current fiscal situation in the UK economy and in the Japanese economy? So macroeconomists, I will write it as this, macroeconomists, when look at any country, look at the following. So think about if you were a macroeconomist and I asked you, Salman, or whoever is in the chat, what do you think about the economy of China, or about the economy of England, or about the economy of Japan? The first thing you will look at, you will go on the online, on internet, and you will look for the following data. What is GDP? So what is the gross domestic product? Now, Salman, tell me, I asked you last time, what are four main components of GDP?
So interest rate, government interface, and the government is spending, net exponents, consumer spending.
Yes, and investments.
Okay.
So, do you guys understand what does mean consumer spending? What is C? Do you have understanding what is consumer spending?
Consumer spending is like the big company which used to spend the company which
No, okay, I'll explain it. Now think about it this way. You're from India, right?
Okay.
And let's say the following happens. So you can correlate the fundamentals that you have in the Forex factory with what actually happens in the economy and how the market reacts. So let's say you told me you have a brother, you have family, and let's hypothetically assume that all of your brothers or sisters except your father got fired and don't have a job anymore. Okay?
Okay.
What you will do, you will reduce your spending, meaning you will no longer go to the mall, you will no longer go on Saturday night out, you will cancel your vacation that you wanted to go, because you will reduce your spending, because that money is now important to you. Okay? Now imagine when this is done on the whole of country of India, and when some economists look at whatever was spent in that country. For example, Bart bought, I don't know, a car, Maras bought a house, you bought some goods in shops like bananas, I don't know, milk, car tires. Whatever is bought in one country is consumer spending if it is bought by its citizens. Okay? So that is a part of GDP. And that is why it is statistically important, because you see how many people are spending. If we have increase in unemployment was on Thursday or Friday, increase in unemployment, that leads to decrease in spending. Do you see?
In consumer spending.
Yes, decrease in spending in consumer spending. If there is a decrease in spending, what happens to GDP?
GDP will fall
because GDP is no longer 5 but 3, because less people are spending money. If less people are spending money, the economy contracts. Okay?
Yes, sir.
Is it clear? So also investing is another part, government spending is another part, and net export is another part. So you see how fundamental data you were given in the, for example, next week we have CPI on Wednesday, I believe. Last week we had non-farm payrolls. You see what macroeconomists expect. If we have increase in jobs, for example, then we have increase in spending, then we have increase in GDP, and the economy looks stronger. You see how everything is correlated. It is not easy, but it can be understood if you study a lot.
Yes,
So,
sir.
what do macroeconomists accept GDP look at? Accept GDP, if you would analyze country like England or like Japan, accept GDP, you would look at inflation. Because you would like to see what is happening with the prices in one country. Okay?
Yeah. So can we go in brief of inflation? What is inflation? What's the cofactor?
Inflation is change in goods and services in one period. Let's say that is what is inflation. So let's say yesterday your milk, let's say your milk you bought was $1. And the year after, that milk was $3. That means that CPI year over year, because next year you compared it to the last year, was 300%. Okay, that was actually means inflation is 300%. Okay, is it clear? That is what is inflation. The changes in prices of goods and services in one period. What happens to the price that changes? If you had a service, for example, you're a doctor, and last year your price for your examination was $100, but this year it is $300. That is inflation. Okay, so usually countries like inflation to be around 1%, 2%. So long-term goal of monetary policy is have inflation at 2%. And that is when you now as a macroeconomist look at, and you see, now let's say you're looking at GJ pair, you see England has inflation of last inflation 10.4%, and long-term goal is 2%. On the other hand, Japan has inflation of, I think it's around 5% or 4%, and its long-term goal is also 2%. Okay? Are you following me?
Yes, sir.
So what do you have? You have current macroeconomic situation that tells you GDP in the United Kingdom is strong. It's also strong in Japan, but inflation in UK is 10%. Inflation in Japan is 5%. And both countries have long-term goal of having a 2% inflation.
Yeah.
And usually inflation is taken care of by monetary policy.
Monetary.
Yes. Monetary policy means what the central banks does. Monetary policy is central bank policy, okay? Because central banks influence interest rates, and interest rates influences inflation, and that's how inflation falls. I could expand on it, but for now it will be enough. And another third part that you will look at is unemployment. So another part when you look at the macroeconomy of one country is looking at unemployment and how much of people are employed. And that's when you decide and you, let's say, make a conclusion of what is happening in the economy. So now this is the macroeconomic data of GJ. And now you see, what do you have as a conclusion? Conclusion is the following. We need to bring inflation down, right? To 2%. To get inflation down to 2%, Bank of England has to be more aggressive than Bank of Japan. Okay, is it clear?
Yeah.
Because Bank of England has 10.5% inflation and Bank of England has only 4 or 5% inflation. Yes.
Yeah.
So what do we, how can we, let's say, check if we are right? To check if we are right, we go to the Forex Factory. Let's look at the Forex Factory. Let's go down at the interest rates. I think it's calendar. Interest rates. Okay, let's see. GBP has 4.25% inflation, while Japanese yen or Japanese central bank has inflation of minus 0.1%. So actually, you now know that Bank of England is actively trying to fight inflation because it is raising its interest rate. If you look at the history, you will see it is raising. Well, Bank of Japan is actually way less aggressive. I would say almost not aggressive. Then you understand, what is the conclusion? If we have, just a second, if we have aggressive Bank of England, okay, we have aggressive Bank of England and let's say passive Bank of Japan. That's last time I was talking about hawkish and dovish. Yes, Bank of England is hawkish, Bank of Japan is dovish. So you conclude that England will fight its inflation because it has to, while Japan will not. And then you say we fight inflation by raising interest rates. Do you know what raising interest rate means?
Raising interest means in good of currency, sir.
Yes, good. Okay, generally raising interest rates is good for currency because it increases the think about it this way. It increases the amount of money. Interest rate is a rate set in banks. So let's say if you have $100, it is better to have it with a bank that has 4.25% than the bank that has minus 0.1%. You see, you would rather put your money where you will get 4% per year than minus 0.1. That's why you go to England and you put your money in England, meaning you put your money in GBP, and when there is high demand for something, it is worth more. Remember the analogy of the girl. If there is 20 guys that want one girl, that girl is highly valued. If there is only one, she is of less value. The same thing goes in currencies. If we see higher interest rate, that means the currency of that country is stronger. And now we conclude GJ should and will go up. That is conclusion. You see, this is the macroeconomic data that we actually, that understanding fundamentals and what is happening in the world, then we say GJ will go up. And then since inflation is actually happening in the last year or so, year and a half, what do you see? You see we have boom, bullish strong movements.
Yeah.
That is actually how trading is done if you want to make a lot of money from trading. Okay. Now that we have fundamental factors that tells us what is the way that the currency will move in the long run, we need to understand the market sentiment. So market sentiment means what is the most recent news or data that are happening in the world and how will they affect my pair. Okay. As I said, Japanese yen is usually a safe haven currency. So when you have a lot of fear, uncertainty, and doubt in the market, usually investors flock to safe havens. Safe havens are gold, safe havens are Japanese yen, safe havens are Swiss franc.
Yes. Last Zoom meeting you told us Swiss franc, Japanese yen, and gold.
And when you had banking crisis, can I take it over? Yeah. When you had banking crisis, it was around here from the beginning of March. SVB bank collapse and Credit Suisse collapse. And actually, everybody was afraid that 2008 year will repeat, and that's why everybody started to run to safe havens, meaning they started buying Japanese yen, and that's why you had this movement down. But we knew, and we told you on Zoom meeting, we are still looking for longs. But anybody can be wrong. For example, I can be long on my macroeconomic data fundamentals, let's say around here, okay? And I'm searching for a TP around here. And then let's say I put my stop loss somewhere around here below this support. And then I don't know something. What happens was SVB Bank gets bankrupt. You have Credit Suisse problems. Stupid investors flock to safe havens. And then I lose my money.
Yeah,
it is possible. So don't even if your macroeconomic fundamental are right, you can still lose a trade because you can't predict these types of events.
Exactly.
And I will tell you another example. I know, since I studied the SVB Bank and the Credit Suisse Bank, I know that they don't have any actual effect on the situation that it will be like another 2008 year. I can explain some other seminars. We can go for, let's say, in next seminar, I will explain to you how banks actually work and why I am sure that 2008 will not repeat, because I can prove it due to the fundamental knowledge, and I know how banks works. And even SVB Bank it's such an unlucky case that they got bankrupted. It's just one bad decision actually took them out. Okay, but we'll leave it for the next time. So we have macroeconomic data that tells us go long on GJ, look for longs. Then what you do is you look at the market sentiment. You know what happened here. You could have been taken out. What you have is now in the current sentiment is like a calming of the sea. You don't have that much problems for now. What you do have is another problem, current market sentiment. Let's write it like this. Market sentiment. You have fears of inflation, fears of recession, fears of recession. How do I know that? Because of the USA economic data. That means we talked about last year PMI data, PMI services and PMI production data. Then we have unemployment. We have employment. All these data are actually currently telling me that the current market sentiment is that there is a fear of recession. So this is important to me when talking about gold, that there is a realistic possibility that if we continue to have current and continuing fear, that gold prices will go up. Okay? And then we look at current situation on GJ. So looking at the current situation is actually fear of recession, as said. That might be, let's say, a short-term bullish on Japanese yen, meaning bearish on this pair. But overall, I am looking for longs. Okay? I'm looking for longs. Okay. And understanding that I'm looking for longs, I will look for technical analysis. Then what we have is number 3. Let's say GJ, let's call it, I'll leave it like this. Then we look at technical
analysis
for best entries.
Okay.
We'll leave this for gold. Just a second. Okay, so these are all things that I have in my mind when I'm looking at GJ pair. Do you remember we were actually expecting GJ to like a retest 61.8? I was expecting to buy somewhere around here. It didn't. It went up. It is what it is. I missed my trade. So macroeconomics tell me go long. Currency and the second thing tells me market sentiment. Tells me I will just let me like this open. I will call it market sentiment, so you have it more nicely.
Yeah.
Current market sentiment tells me there is a fear on the market. Don't be surprised if you have further reaction to the downside, but it should go up in the long run. Okay.
Yeah.
So this all tells me the following: look longs for GJ at best technical price areas. As Maras drew, it can be here, it can be even here, it can be here. You can draw a Fibonacci from here to here. I will share when I find my entry. You see, you can enter maybe here. There are several possibilities. Nobody knows where the price is going to come. Nobody is psychic. Nobody can tell you. Anybody who tells you there is a magic order, black order here, I know the price will react, he's a liar, he's a scammer. Nobody can tell you where the price will actually go. But we can tell you where the price will go in the long run. And then what happens when you have this type of knowledge, then you can catch these moves. Because you know in the long run it's going up.